All right, good afternoon, everybody. This is Event Trader. I am going to be joined by Chart Trader here. Brett Manning, you with us?
Yeah, I'm here, Gav.
Okay. As you know, you've probably seen the updates on our site. We're currently running a promotion, so we probably have a lot of people listening that are new to this segment. So just wanted to give a little quick color, and Brett's going to give a recap of some of our past discussions here. But in general, the point of this is to take a look at some of the sentiment and flow data, as the title of the segment would show, and just take a look at where that fits into the current context of the market where we've been trading, activity that we've seen out there, and trying to point out any oddities or trends that are emerging from the set of data between sentiment and flow, using it kind of as a nice mix together to get a good picture of the markets. But Brett, you want to give a recap of what our last discussion was about, and maybe just kind of recap what we've been talking about the last couple of sessions here and how it fit into the context of the market?
Yeah, I want to do more than that. I want to go back to to try to get people on board the narrative who haven't been listening to us, because I think that every point that we're talking about here is really only useful when you understand it in context. And I think most points of data are generally like that. So this is generally a data-driven approach to the market, only it's using types of data points that the majority of market participants don't look at, and that's where the edge comes from. That's why you can be right this way, because it offers you access to an angle on the market that's true, that's quantitative, that's factual, but that most other market participants aren't watching, and that's really the source of edge in terms of predictive analytics in markets. So, but to understand that data and what we're going to be talking about for the rest of the time, you need to have a sense of the story so far. And for you guys who've been listening to us for the last 8 months or so, just bear with me for a couple minutes. For people who are new, as Gavin said, we're looking at sentiment data points and money flow points in the context of economic and earnings-related fundamental points and technicals, to try to understand how it all connects up and where there's an edge, where people may be leaning the wrong way against a trend that still has a longer-term basis, or those types of ideas. So really, to understand the story so far, I think the first point to go back to is actually the tax reform bill in late 2017, which was a big $2 trillion fiscal stimulus. And that kind of sets up a series of comparison variables that really bring us up to date and understand why sentiment was so dreadful this past year in essentially July, August, and September. So if you go back to late 2017, we did a $2 trillion fiscal stimulus. And really the zone of what you would call second derivative economic impact was in Q3 of the following year for that stimulus. A lot of that $2 trillion really influenced economic behavior that peaked in a window around July, August, and September and October of 2018. That's when we saw a big breakout in a lot of things. And the market made new all-time highs, and then we rolled over as that window waned. But that window set up a kind of bubble. If you imagine like a bubble under wallpaper and you keep pressing down and it pops up somewhere else, everything really popped up and crested during that period. So when you fast forward to a year later, which is 2019, during that same period, you end up having year-over-year comparisons for data that are against really a skewed understanding of reality, where the market and the economic data and individual company earnings growth, everything was propped up by this $2 trillion 12 months previously. So everything is being compared to that. And that's, of course, when we started to get inverted yield curves. That's when we saw recession expectations in fund manager surveys spike up to 37, 38% of large fund managers. That's when we saw inflation expectations dive down to 2, 3, 4% for large fund managers. And it also happens to be that during that same period, this 2019 sort of back half comparison point in the autumn, that's also when the trade war with China really flared up at its worst point. That's when we threw in the towel completely for the progress we had seemed to make up until May of that year. That's when we started to ratchet up the tariffs further. That's when it looked like a spiral. Everything was really tanking. So at that point, that's when we have a real trough in sentiment. It doesn't look that much like it in the market, And that's just the point. What we're trying to do here is isolate when things are off kilter, when there's something that's driving assets higher, but the cyclical money, the sort of wishy-washy money, is all on the sidelines and scared. Those are usually the best buying points in an upward trend. And that's exactly what we isolated on the show. We saw those data points. We saw the money flow data points. We saw the sentiment data points. And we realized in the context of that narrative that that's a point that's not necessarily a structural flaw or a cyclical flaw, that it's this sort of uneven comp situation. It's the trade war. We believe that there was going to be at least a sort of superficial resolution to the trade war toward year end, especially in front of an election year. And so it really was the point where people are overly bearish, and we saw a lot of data points, money just pouring out of equities, pouring into bonds. A lot of the surveys were at rock bottom. Inflation expectations were at bottom. Recession expectations were at the ceiling. We had the inverted yield curves. We had a lot of the options data that was really in terrible shape. People were just owning nothing but puts. Money managers had hedged away everything in their portfolios. That's the type of point, and Gavin and I got very bullish during that period. And you can go back and listen to those shows and look at our summaries. That's when we really said we're heading towards some kind of big breakout to the upside. So when November came around, we got another big point here is when the Fed came out and then started to basically pledge that they were not going to hike rates unless they saw a manifestly difficult, problematic inflation situation. Not just leading indicators that showed things picking up, but actually a problem with inflation. It's the first time that we've maybe ever heard the Fed say something like that. So that goes into that context. Then you get the trade deal with China, and the market is just off to the races. And our view at that point was, we're going to get this big breakout. We're going to get a big run to the upside. Now, the question is, when do we get to the point where there's so much risk acceptance in the system? There's so much vulnerability built up because so many new people have gotten so over-leveraged and excited about the stock market that this whole thing is running its course. In other words, the other end of a kind of blow-off dynamic. If you think of 1999, that sort of market dynamic. And as we've talked in the last few weeks, we're starting to see some little signs of that, but the whole thing isn't really there. There's some options data that's there, but a lot of other data points that we're going to be talking about didn't really get there. What we do see is that we're kind of past the stage of this bull market that one would reasonably call a wall of worry. And that really wasn't the case up until last fall. It's really only this process and this big next level breakout that has taken us to the point where you're in the stage of this bull market where we're past a wall of worry. It's crazy for a wall of worry phase to take 10 years. That's the first time I think that's probably ever happened. Usually you're talking about the first few years of a bull market. This case, this was a very slow burning bull market. People had stayed pessimistic or skeptical for a long time. But we've gone around that corner now and we're in a different phase of this thing. And we're looking for sentiment data points to get to maybe multi-decade extremes before we start to say that we've seen too much, this is running too hot, and that it's due for some kind of serious correction. So I think that as we come into, we've gotten close to some of those kinds of points of exuberance in the sentiment data, but we haven't fully gotten there, not to a full-blown case of euphoria. We've gotten there in options data, in hedging data, particularly among large money managers, but we haven't gotten there in terms of the whole market context. And every time we've gotten close in the last few weeks, we've gotten some kind of big exogenous catalyst to kind of reset things. First it was the Iran military conflict. Now it's the Wuhan flu. But we keep getting these things that kind of reset things and prevent that full blooming or blossoming of what you might call market mania. So that's where the context is at this point. And for the rest of this, we're going to be taking a look at data points to try to show where we are. So there's you are here summary.
Very good as per usual, Brett. So with that, let's break into some of these data points and start breaking it down and taking a look at the market picture. But we'll start off first with some of the data points from Jason Gephardt, Sentiment Trader, which we follow religiously, and you have laid out a number of primary points that we use as the basis for this show. Now, these tend to run into scales of extreme pessimism and optimism, and just taking a look at these could give you some insight into the market. So with that in mind, let's take a look at the ones that are showing signs of extreme pessimism, and in this it's kind of an inverse relationship where you kind of want to buy low and sell high in terms of the pessimism and optimism. So on the pessimism side, I noticed a big jump in inverse ETFs, which basically means more people are jumping into these inverse ETFs as a way of hedging. I found that to be an interesting data point, Brett, given the fact that we haven't really seen as much of that on the option side of things. We'll get into the Lobo and Robo here shortly. But from your take on this inverse ETF, do you find that to be more retailers that would be using this as a vehicle to hedge?
So I think that there's a few data points that we normally cover that are updated daily versus ones that are updated weekly. And what you're seeing is hedging is happening everywhere right now, but some of the options data points like the Robo and Lobo, they're updated weekly. But SPY liquidity premium, inverse ETF volume, those are updated daily. And so you're seeing the impact of the coronavirus come into the whole picture, and we're just getting the part of that window that we see where the data is updated daily. So every day you can get data on inverse ETFs. I think that they're very widely institutionally used at this point because there's a ton of liquidity in these things. And really, when you're talking about is this retail or is this institutional, I think the conversation starts and ends with where you can get big amounts of money in and out of something quickly. And inverse ETFs used to probably be more retail and less institutional, and now there's so much liquidity that I think that I think you've got people who are looking for ways to hedge. If you've got if you really believe in Amazon and Apple, you own a lot of them, but you want to hedge against this, you could just, you could buy the QLD or the QID, which is short NASDAQ 100, and anything that happens that's going to impact from a macro standpoint those large cap technology companies and hurt your portfolio, but you're going to get the better end of it because of the earnings that are coming out with Apple. That's the perfect position to have on right now if you're right about Apple and you're right about large cap technology companies taking a hit. The difference between those two is a perfect positioning. I think you're seeing that kind of thing. And to jump ahead of you, the SPY liquidity premium is, essentially there is a lot of trading that happens in ETFs and for everybody, and particularly people who are managing large amounts of money on short time frame strategies where they want to be able to know that they can get out quickly. And so they stop trading individual stocks and they start trading the big ETFs because they know that they can move large amounts of money in and out quickly if there's a big headline that goes against their position. So anytime you see a very headline-driven market, you're going to see something like the liquidity premium for the big ETFs move up a lot because it means people are trading the indexes rather than trading the individual stocks. So you've got a headline-driven market environment where people are seeking hedging, but there's not really anything here that says that they don't continue to believe that the upside is where they want to be positioned in terms of their individual investments.
Right, and with that in mind, we did see the VIX 14-day RSI jump above 75. Naturally had a pretty big rally in that from 12 to 19 over the last few days as people start ramping up that hedging activity. You taking away anything from the VIX? I mean, obviously, you'll probably start seeing some pretty big extremes in terms of the moves just with how depressed it was and how unchanging it was. But are you taking any readings from this at all?
Say that again, sorry.
For the VIX 14-day RSI jumping above 75, do you just see that more as a product of how low the VIX had been running before this? It was running at 1250 as low as recently as Friday, and then we saw that big jump up to 19.
Sure, that as well as the tightness of the range and just the general fact that we've watched this trace out across the market. The idea that, as I said in the beginning, I think that we've gone past the wall of worry phase of this market, and part of that would be a really depressed VIX, but not only just a really depressed VIX, a consistently narrow band around that VIX, so that the moment that you get some kind of big headline catalyst that people have to rush into hedging for, you're going to get an outsized pop in some of these oscillators that are looking at relative changes over time frames, because it's a new dynamic and people have become particularly complacent. I mean, that's almost the definition of being past the wall of worry dynamic is the buildup of complacency. So yeah, I think that when you've got suddenly the possibility or the risk of a global pandemic popping up in the middle of a very complacent VIX and one that has been so for 30 to 60 days, then yeah, it's easy to see how these oscillators attached to it become dramatic instantly.
Now we still have plenty of the surveys in under the Optimist side. Most of the fund manager surveys from the newsletters continue to run there. Mutual cash has moved into the optimistic side. Hedge fund exposure, although that still is low and room to run there. And the same could be said about the AAII data, which comes out on Thursdays. Moving in to that bullish territory, but hasn't hit the extreme. But I guess the one item that I found interesting was between the Robo and Lobo ratios for the retail and large owners of options. Where the Robo, the retail side, was really lagging the Lobo ratio. Lobo is for anybody with over 50 contracts in terms of optimistic territory. So the Lobo people are obviously taking that first mover advantage and looking to hedge against some of their positions here. You want to discuss that dynamic a little bit, Brett?
Yeah, so first of all, for people who aren't familiar with some of this data, so the AAII that Gavin referenced is the American Association of Individual Investors. It's a survey for people who are actively involved in markets, and it basically asks them, where do you think the market's going to be higher or lower or the same price 6 months from now? So as he noted, we've seen the ratio of bears to bulls in answers to that survey basically stay relatively contained. It's not exuberant. It's not sitting there saying that everybody who's answering that survey thinks the market's going to be a mile higher, which would be a contrarian indicator. It's saying that people are sort of tempered still in their expectations for the market based on their answers to that question. The hedge fund exposure point that he discussed is basically looking at the relationship between the hedge fund tracking indices and the S&P. So you can actually see, based on how hedge fund portfolios are doing, which is taken in by HFRX, and how the S&P is doing, when they're highly correlated, we make the inference that hedge funds are highly net long stocks. So if you imagine they're 100% long, there would be perfect correlation in how the average hedge fund is doing versus the S&P. And looking at the ratio between the Robo and the Lobo, so the Robo is the retail only buy to open put call ratio. So this data is actually taken from clearinghouses, and it shows that somebody who's entered an options position, it wasn't a hedge, it wasn't the closure of another position. So if you buy a put, it's not because you were short a put. It knows that it's open only, right? So it's the buy to open puts. So retail only buy to open means people trading smaller than 50 contracts at a point, which generally speaking, we're talking about retail traders at that point. They're buying to open a new position. So if they buy a put, that means they're taking a bearish position on an instrument, right? So when you look at the Robo ratio versus the Lobo ratio, which is the large only buy to open, there you're talking about professional money managers. There's a difference between how the two are performing right now. And the large only versus the retail only are basically, they're more protected. They're less exuberant. They're not just buying all calls and no puts. And when you look at some of the Robo data points, you're starting to get the sense that a lot of the smaller traders in the options markets are focusing much more on just buying lots of calls and not any puts. And usually when that gets to an extreme, that's a really good time to short the market. And at the end of the day, what we're trying to do here is figure out when you get to extremes and you have a strategic advantage based on this data, because again, as I said in the beginning, there's not a lot of other market participants, certainly not a majority of market participants who are looking at these types of data points. So it's not discounted into the market, which gives you an edge. So we're looking at these data points to try to give you that edge. And in this case, when you see the Lobo ratio at a much more tempered place than the Robo ratio, you have the sense that professional money managers are starting to focus on puts a little bit more, and they're seeing the risks out there, whereas retail traders are starting to really just load up on calls. That gets you closer and closer to the point where we want to start looking at either defensive positioning or actually shorting the market. And at this point, I think that a lot of these things are evolving toward where we could see a protracted period of these sorts of data points that gets much more extreme than this before we want to take action. Because, again, we're at this sort of new phase of this bull market. And if you look back to the late 1990s, just as an example, some of these data points, and they're tracked all the way back that far, some of these data points got much more extreme during that period because you start to get a lot of new people, and Gavin's going to talk about this in a minute, actually. You start to get a lot of new people, more retail-oriented people, who haven't been participating in what has been a very professional, institutional bull market for a lot of years. Suddenly there's a lot of people, your next door neighbor is starting to realize that he can get rich in the stock market, and he starts to lever up all his cash with options and to try to catch that next big breakout. So you start to get that sort of dynamic, and it takes a while before you build up that type of extreme. When you have those new participants coming in, you start to skew some of these options ratios, and in the late 1990s, something like the robo put call ratio got way more extreme than we see it today. So I think that we're going to get to another level of extremes with these sorts of things as we start to see some of these new participants coming in, and Gavin can explain why we think some of those new participants are coming in.
Yeah, so I mean, basically, what we're looking for is weak hands for strong hands, with obviously the larger players being the strong hands, and that's the good underlying data. And what Brett's referring to here is recent reports from the discount brokers have been showing a big return of enthusiasm in the retail investor. People looking to trade stocks a little bit more actively. The last time we saw these levels would have been January 2018, which is arguably the last time we were in a quote-unquote worry-free zone. Recall, this was when we were flying into January, hitting all-time highs, and then all of a sudden the trade wars started to unravel, and that's when the markets started going a little bit more in a sideways direction over those coming quarters.
Well, let me interject real quick. I see also data showing from E-Trade, TD Ameritrade, and Schwab that says that actually retail is the most active they've been in over 15 years right now.
Yeah, exactly. So, just big jumps. Now, here's the one problem with the data set that we don't have from prior data points, and that is, of course, when Charles Schwab announced a couple of months ago that they were going to zero commission trading. Obviously we've been talking about Robinhood for the last few years. They were doing the zero commission trading, and they were really starting to cut into the big boys there. So now we're seeing everybody go to that business model, and eventually you lead, of course, to Schwab buying Ameritrade when Ameritrade's stock price was weakened by this because they had the greatest percentage of commission fees from these trades. So I guess it is a little tougher to take away the extreme readings that we're seeing there, Brett, right? When you see 15-year highs on these levels, it's definitely notable because, it suggests that some of this extreme runs that we've seen to kick off 2020 could be a lot of these weaker-handed retail players getting involved. But, one also has to wonder how much of an impact the zero commission is having on these numbers here. So, Brett, what would be your key takeaway from this and the activity that we've been seeing since these numbers started popping out and showing this improved participation by the retail investor? Because just to add on to this, too, for anybody that's watching, it's something Brett and I have been talking about for a while, the lack of participation by the retailer, probably most evident in the lack of stock splits that we've seen over the last couple of years, which is just a simple way of kind of looking at companies looking to lower their stock price via a split in order to get the retail investor more involved with them. Just adding this all up, we're certainly seeing this next leg when you factor in the robo and the lobo and this participation that the discount brokers are showing as this recent leg being a breakout of perhaps some weak-handed shorts, or longs, I should say.
Yeah, no, I think that I think you hit the nail on the head. I think that this has been a process that has been constrained from the retail side, and I think that it will probably continue to be constrained for a period where we've got demographic variables and other variables involved that really constrain the retail participation side. And stock splits is a great data point to look at that, because that's really how companies market to the retail investor. And they see no need to do that. Stock splits used to be, hundreds per year, and now it's like 5 a year for major, highly traded companies. So really, you see these stocks building up to 1,800, 2,000 plus dollars per share, and that's really not something that retail investors tend to participate in a great deal. So, there's lots of data points that suggest this is an extremely professional, extremely institutional bull market. But this moving commissions to zero, it sets something off, and whatever's out there to exploit, whatever's out there to be brought in on the retail side, we're starting to see that be brought in. And I think that there's a sort of narrative element here too. If we see things really work out well, so we've got more folks involved right now on the retail side. If the market pays that off, there's going to be stories that come from that. I think that a lot of this is sort of a viral transmission. If people, your next door neighbor made a bunch in the stock market, you're more likely to say, I need to take a look at trading some stocks, and how much of a budget is put toward marketing to that group. These are all a lot of different factors.
Very reminiscent of back in the late 90s and early
Certainly.
aughts when you would see those commercials about the guy owning an island. And
right.
And
get to the good life, trade stocks.
Exactly, and everybody just started jumping in. So it's funny because it's a dynamic that I think we kind of neglected when we were watching that retail exposure and or the lack thereof, and the idea that these guys were all going to zero commission fees. So I find it an interesting data point, but tough to ascertain exactly what it means given that zero commission variable that's involved here.
It's tough to parse it out.
Yeah, but something that we will be watching. Another thing that we had been watching too, Brett, and I'm going to go off three things here, is basically we got the high-low ratio, which Brett and I talked a lot about in terms of over the last couple of weeks, because it kind of shows the diversity in the markets where 52-week highs and 52-week lows were hitting their largest spreads in a number of years here, meaning that people were all piling into the good names and leaving the value traps, if you will, alone. I mean, it's a dynamic that we certainly saw play out through 2019, so not surprising, but it was definitely getting to extreme levels. And then just throwing in, there was a Hindenburg omen, and trust me, I don't put any basis in that, but what it does show is that, there is a diversity in the market that leads to a little bit more confusion, and thus can lead to a little bit quicker profit taking. Just on the idea, if you're looking at the high-low ratio, is the idea of we see any weakness in the markets, people would be a little bit quicker to take profits off of their big names than they would be to buy low value names at that point. So it could lead to a little bit more of a dramatic correction, and we've seen a little bit of that play out over the last couple of days here. But Brett, do you have any thoughts on the current high-low ratio?
No, I mean, I think that I think it's interesting that we see the narrowing of the market around a number of precepts, and everybody seems to pile into the same names. I mean, it's been something kind of extraordinary where you get some of these market caps. I think particularly in terms of mega cap tech, it's almost as like people believe that there's a territorial claim to every new idea in the future because of some of the legal departments that these large cap technology companies have put together. They seem to be able to suck up every new innovation in some level, and I feel like people are just continue to pile into the same names. And there's also the inflation debate runs right into this, right? I mean, are you seeing inflationary growth, or are you going to continue to see the same kind of backdrop that has defined most of this bull market, which really is how can you get a return on your investment when we're not seeing real animal spirits in the economy? And we keep trying to steepen that yield curve, and it keeps on kind of falling back into this same setting of, well, we're going to need to get into Google, Apple, Amazon, etc., because they're going to end up with a way to make money even if we don't get inflationary growth. And I really don't see, we keep looking for the corner to turn and to see, some of these materials companies and heavy industrials start to play catch up, and start to see this turn into kind of a full-blown, broad bull market burst where you get new highs and everything, and it just keeps kind of falling back into the same pattern, and it looks like that's sort of happening again here.
And here's the interesting build off that, Brett, because we talk about looking for changes in this dynamic. And one thing that jumped out to me too was the percentage of buying climaxes. Now, basically, what a buying climax is, a stock that hits a 52-week high and then reverses to close below the prior week's low, or the prior week's close. So more than 10% of stocks triggered one of these buying climaxes over the last 2-3 weeks. I'm not 100% sure on the time period, but we were seeing a pickup in that activity, and you can see it kind of play out in the charts. As anybody who follows me knows, I go through each of these names when I'm doing my earnings previews, and I've seen this dynamic play out a lot. So you got any thoughts on the buying climaxes, and could this be perhaps the breaking point of that high-low ratio?
Who knows, but I would say that makes perfect sense to me if you have suddenly all this retail money flowing in right in front of earnings season, and you've maybe kind of gotten your ahead of yourself a bit, and then you get something like this coronavirus scare. You might see those kind of patterns maybe be a little bit prevalent under those conditions.
Okay, and we will jump into some thoughts on the coronavirus here shortly, but let's move over, Brett, to some of the flow data that we've been getting. The Bank of America Flow Show and fund managers surveys, they do a phenomenal job at providing a look at the assets under their management and how people are acting. We can ascertain, general directions from that. So one of the questions that the Flow Show asked was, where does irrational exuberance come in? And they noted that it was about 30% above the 200-day moving average in 1999. This would equate to the NASDAQ coming in at 10,600. We are, I think, about 22% over the 200-day moving average, I believe. I'd have to double check that. But this certainly suggests some room to run based around some past numbers that we've seen. You got any thoughts on this?
Yeah, I've been kind of thinking about this comparison with the 1990s because it looks so tasty, especially on the NASDAQ chart. And, where I land on this a little bit, I mean, I remember that period. You remember that period. There's a lot of people listening who were in high school during that period or earlier. And Gavin and I are old, so that's just the way it is. We remember trading this period. Yeah. And the reality of the situation is, there's a very different climate. I mean, that was elevation on a theory. That was the idea that we were seeing a once-in-a-century revolution that was changing everything about how everything would work in the future, and valuations didn't matter at all. And a lot of stocks, like if you imagine how Qualcomm behaved during that period, the idea was that it was going to enable a type of communications infrastructure that was going to redefine how the world worked for decades to come. And so nobody worried about what the company was making, next year or next quarter. It didn't matter because it was a redefining revolution in the way the world worked.
It was like what we saw with Bitcoin just 2 years ago.
It is very much like that.
You just see people throw Bitcoin in their company name and the stock would go up 40%.
Well, yeah, but but the thing is, for the dot-com bubble, it actually was right. Yeah. Qualcomm did that. That's how the world now works. It was ahead of time. It was discounting a revolution, but the revolution was correct. We ran into a big hitch in the middle there because, by 2002, people didn't see the flying cars. It wasn't evident that the revolution was 100% redefining the future of the world. But here we are, a decade and a half or 2 decades later, and it happened. Yeah. Like that, all of that absolutely did redefine the way everything is done in the world. Now,
there was some similarities, though, on the monetary policy front.
Yes, but I think right now this is a fundamentally different situation. This is not stocks elevating on a theory.
Right.
about complete revolution of a once-in-a-century type about how the world is going to work 10 years from now. I mean, Apple's really making that much money. There's a difference in terms of valuations, certainly. Now, there's a cloud thing going on. There's an AI thing going on. There's a big data thing going on. There are some revolutions percolating in there, and there's some groups of stocks that are moving on the basis of
All different chapters on what that basis was, basically.
yeah, they're all building on this prior revolution in different ways of again revolutionizing the way a major factor works. But broadly speaking, the market isn't trading on a theory right now that's just 100% theoretical. So I don't know if I look at something like the Hartnett note about saying what percent above our 200 daily moving average defines the notion of irrational exuberance. I think we're seeing a narrowing of breadth. And again, I think that a lot of these mega cap tech companies, I think that the biggest risk to a lot of what this market is doing has a lot to do with how we redefine the notion of competition in this economy, and whether or not we're going to start saying, we need to break up some of these companies because we need to redefine our understanding of how we need to maintain competitive boundaries in industry, because the way that we did it 100 years ago doesn't really apply to the way that a company like Amazon exists in the world today. And I think there's a lot of things like that could happen that would reshape things, but really it comes down to 4 or 5 or 6 companies that are able to keep on taking more and more territory and redefining it in a way that's going to work for them, and more money piling into them and their supply chains. And that's doing a lot of the work right now, and that's really inflation independent. And it's defining a lot about this bull market, but that's a regulatory issue. And it's not so much like what we saw in the late 1990s, which was truly a revolution that was discounting something that just took longer to manifest itself in an obvious way. So I'm not sure that the comparison's working for me quite as much anymore.
Right. No, that makes sense. So taking a look at some of the inflows, we had 16 billion into bonds, 8.5 billion into equities there. Year to date, that's 56 billion into bonds and 21 billion into equities. A marked departure from the outflows of equities that we're seeing throughout the case of 2019. Bonds continue to see that buying. We're not really seeing as much of a depression in some of the yields, and we'll get into that here in a second. But and on top of those equities too, don't forget we got 21 billion into equities, and then you got a return on your investment as well, leading to an even greater percentage of exposure to equities there. Some of the biggest inflows were into gold, Brett. Gold saw the biggest inflows in 17 weeks. Think that has a lot more to do with Iran than anything else?
Well, I mean, you're talking about the flow show, right?
Yeah.
Yeah, so I would say that's coronavirus.
Well, don't forget, this data would have been from January 24. So,
Yeah.
I mean, the coronavirus, I guess that was starting to hit in 2021, but I would have thought that Iran was more of a gold play than the coronavirus, personally.
Yeah, but then we're talking about the third and 4th of January. I mean, that was resolved by the 9th.
Yeah.
So
Yeah.
I think we're dealing with pandemic possibilities at that point, which I mean, we should.
I suppose. I guess it doesn't match up for me for why you'd buy gold because of a pandemic, which I would view as more deflationary. And it's not like you're going to get a breakdown in a country's currency because you would compared to, say, a war or something.
I don't know. I mean, I think that the market is not thinking it through quite as much as you are, quite frankly. I think that you're just saying, well, we're going to hell in a handbasket for one reason or another. If that's the reason, fine. They're going to have to print a bunch of money.
Yeah.
So, I mean, I think that gold has just become, the defaulter. And I think that I'm long gold. I've noted that on the site. It's for reasons other than the prediction of a pandemic, but everything seems to be working more or less in gold's favor right now. It finds one excuse or another to perform.
All right. And then we also saw tech inflows hitting an all-time high and ESG inflows accelerating. I've been talking about this the last couple of weeks. This is, of course, the environmental, social, and governance um, companies that, for my money, I've been going through, and it's really tough to define who who can be. I mean, they all talk the talk. They don't necessarily all walk the walk. So it is interesting to see. But those funds, we saw Lawrence Fink talk about it in his letter to BlackRock shareholders. Continues to see investments coming in, so that continues to be a space that I think is just going to be a big winner in 2020. And I'll throw out a list of names that I've come across that fall into this ESG category that I'm seeing across a number of funds. Now, when we're looking at the asset allocation, Brett, for the Bank of America Wealth Management Unit, it's about 60% equities, 22% bonds, 11% cash. Now, the all-time equity high is 62.5% back in March of 2015. With the retail investors continuing to pile in here, um, I could see us blowing through this number. You got any thoughts on that? Especially, I mean, considering it's funny that there's such a small allocation of bonds, yet bond bubbles, and we'll talk about this later in the fund manager survey, came in as the third biggest concern for asset managers.
Yeah, no, right. I think that I think it's interesting that the all-time high is 62.5% in March of 2015.
Yeah.
I mean, that's going to take some thought. That's just, if I had to guess at when we would have seen the all-time equity allocation high for private clients of the Bank of America, I mean, essentially the prime brokerage side at 62% in March of
Yeah,
2015.
and if you go back and look at the calendar, or look at the S&P, I was looking at the continuous. Basically, we had a sideways to slightly down move from there before we'd move back higher. Obviously this was ahead of the election year, so I
It
found that.
was in that range. I mean, it was a range top. I mean, I remember that period. That was actually the middle of a period where we had. Oh, you know what that was? March of 2015. Do you know what that was?
No, what
That was when the ECB first started doing QE.
was it really? Okay,
Yes,
interesting.
it was. That was the announcement of the beginning of QE from the ECB.
And the Fed would
I don't
have
know
been
whether
full.
that's it, but that was when the Fed
The Fed would have still been
stopped.
running
Fed stopped in the
QE3,
middle of the
right?
previous year. Fed stopped in the middle of the previous year and essentially handed off to the ECB as a baton, and everybody was wondering whether the ECB would do it. And in November or December of that year, they said they would, and then they put it in place in March of that year.
All right. Well,
I don't know if that's the cause. I'm just saying that also happened.
yeah, and I guess it's interesting to note that when we did hit those all-time highs. Now, granted, one of the things that we keep seeing is that there is still a little room to run here, as much as we are getting squeezed a little bit. So that sideways action is something that I keep note of. Now, the S&P multiple last week it was at 18.6 times to surpass the January 2018 highs. We had the SOX 22% above its 200-day moving average. 27% has been the historic high. So again, a little bit of room to run in there for the SOX. The emerging markets, they had their largest inflows in 57 weeks last week. This is another theme that we've been talking about would be pretty popular for 2020. Now I'll be curious to see how the Wuhan flu pandemic
Yeah, they went right back out.
impacts this. Yeah, exactly.
Yeah.
Because there's going to be that concern about the China slowdown, and I think one of the things that we can take away from 2019 is it always used to be when the U.S. catches a cold or sneezes, the rest of the world catches a cold. Now it looks like China, when they sneeze, the rest of the world catches a cold, and it's probably a um, poor metaphor to use given the
Yeah.
coronavirus that's going around right now. But anyway, now here's one of the things I saw. Materials was the only area that did see outflows, and it was 10 million in outflows, so pretty small there. But I guess what makes that so interesting, Brett, is one of the things that I was seeing from the fund managers survey was that commodities were, I believe it was at an 8-year high for inflows. that I was seeing. I'm looking for the
Yeah,
number
that
right
is a
here.
very interesting, yeah,
And
juxtaposition of data points.
now, adding to that too, I'd be curious with the crash in copper, which has just really fallen off a cliff. It was down, I think it was 8% over. It had fallen 8 days in a row, and it was more than -3 standard deviations below its 20-day moving
Hmm.
average. Obviously, all this around global concern. But do you think this is kind of the thing where you saw this move into commodities? Obviously, gold plays in here. Do you think this is, and perhaps it's just people buying up soybeans and stuff on the idea that China is going to have to buy all this from the U.S. Now, again, we could go back to that trade deal, and a lot of it pertained to what the prices were in terms of their buying speed.
Hmm. Hmm.
And the knock-on effect is, does that impact how the Trump administration views China in living up to their end of the bargain? Remember, we're in a 90-day period, so these are some things that we need to keep an eye out on. But you got any thoughts on that move in copper and overall the inflow into commodities that we've been seeing?
Well, so it looks like the copper move appears to be something directly related to the coronavirus situation, and China is obviously by
That's a
far and
pretty
away.
big outsized move, too. With
It is. It's a dramatic move. But as you just said, one of the areas we saw outflows was in basic materials. We also saw at the same time back to flattening of the yield curve and this overall move back to, hey, are we going to finally see some markers of inflationary upside? No, we're not. And there's this whole kind of process, this roller coaster ride we seem to be destined to continue on, which is people looking for around that corner when the sun's going to come out as far as kind of heating up of the global economy in a more inflationary growth, traditional late cycle kind of sense of, and money flows coming into the commodities and commodity funds is really speculation about that. It's just like speculation about a steepener trade in the yield curve for bond markets. And for those of you who don't normally look at bond markets, when you look at the long end of the curve, if you see rates go up, short end is tied to policy, long end is tied to trading. When you see rates go up at the long end, short end stays anchored, you see a steepening of the difference between those two. That usually is discounting inflationary growth or inflation of some kind. So people are looking at the things growing, things heating up. Think of that as like the opposite of an ice age. We're heating things up again when you see the yield curve across bond markets steepen. And people keep trying to push for that trade. We keep looking for that in this cycle. We keep starting to see it steepen, and then it just falls back over again, and we start to flatten out. And we seem destined to stay in this kind of difficulty of starting up, pulling that ripcord, and the engine won't start, and we end up back in the situation where we're just printing more money, and we're just finding new ways to stimulate something that doesn't seem to really take off on its own. Like lighting a fire, the flames won't get going, but it just smolders forever. And we seem to be in that same situation now. So possibly people had really piled in or started to move into or started to pull short bets on copper with the idea that we would see this steepening, this heating up. And then we get hit with this, and maybe it was really weak hands. Maybe it was people who wanted to be short copper but got concerned, started to pull those bets off, and now they're diving back into them. Because if you take Chinese active growth out, if you take China kind of turtling a bit around this, if you take a defensive posture in the Asia-Pacific region around this, you really take the wind out of that steepening, particularly globally and particularly for China. This hits Australia as well. So you start to get kind of the wind taken out of that trade, and people are really aggressively moving back into it the other way. And it looks to
It's
me
funny though, Brett, because I do see a buying opportunity in here, and I'll tell you why.
maybe,
Well,
but go ahead. Go ahead.
so here's my thinking. So FCX, Freeport McMoran, stock got clobbered. Now, granted, it had a big run, but it trades in correlation with copper, so not surprising there. Now, one of the reasons why it got hit was there was concerns that people wouldn't be able to work in the mines because of this flu outbreak. They'd be forced to stay home. And, that's certainly understandable, but also that disrupts the supply
Yeah.
a
Right.
lot. And I find it interesting for some of the reasons why people were selling FCX when that supply, it's kind of a self-fulfilling prophecy there for copper in terms of, okay, less demand, I could see that, but also fears that, people aren't going to be able to mine it as much because they'll have to take breaks from this flu epidemic. That works into the
Unless it becomes a
supply
market
picture.
share issue for FCX, particularly,
Yeah, yeah.
given location of mines.
Right, given the location of the mines and, obviously going up against Chilean companies and stuff, that could certainly play in. But
But
what?
otherwise, well, let's take a look at. So, one point I want to make, just we can cover the coronavirus generally speaking and its impact on markets and sentiment data, because we've got to talk about it. And one point that I wanted to just kind of throw out there that, generally speaking, the way that these sorts of catalysts work in a context like this. And again, the context that we defined, we're heading toward easy comps. We're heading toward a situation where we have monetary and fiscal stimulus basically globally right now. We have declining macro risks, and we have the Fed committed to a situation where even if the growth gets spectacular, they've already promised not to hike or even put out hawkish rhetoric. That's the context that you have this in right now. And so I think the question with coronavirus is, at what point will the market know it's not going to be a sort of unbounded, uncontrollable, infinitely bad global pandemic? At what point will we know that this is a containable situation? And as soon as that's the case, that's it. It has no impact on markets anymore. Because at that point, it's not a defect from a structural basis. It's not a defect from a cyclical basis. It's tantamount to really bad weather. You're going to store up a lot of pent-up demand. You're going to get past it. And so markets are going to very quickly look around the next corner. But there is that period at the beginning where you don't know for sure whether or not this is going to become some kind of uncontrollably, unboundedly negative situation for the world. And I think that's basically the equation and the calculus that we're looking at. And that's also fit previous pandemic risk situations. I don't know if you want to comment on that, but that's where I am in my mind with it.
Yeah, no, and I completely agree. And for anybody that's interested, I posted a chart that Robert Schiller had in his book Narrative Economics, which just does a great coverage of how narration tends to move economies a lot. And certainly epidemics is a key area where they take a look at. And if you did a search under my ticker back on January 21st at 1334, and I'll repost this, I posted a link to a paper that he had written that kind of showed the chart. And what you see is just this huge pop at the front end of the belly as the narrative continues to play out. And I think we're in the midst of ascending that pop right now because you continue to see it. Everybody's covering it. Everybody's looking for that next wall of worry that's going to grab eyeballs. And it's something that the average person can equate to rather than some sort of economic phenomenon about what's going on in, say, the repo market and why the Fed's so active there. So it's a little bit easier for people to wrap their heads around and move their money around in it. So with that in mind, this is still going to weigh in on the markets. You're going to wait for people taking a look to see, okay, how's this impacting it? For instance, rail passenger numbers on Saturday, the first day of the Lunar New Year, it was 42% lower than the equivalent day in 2019. You're going to start seeing numbers like that. At the peak of the SARS outbreak, if you're wondering, they were down 57% at that time. So it's getting to be on par with that. So, you want to take a look then at what the impact was from SARS. And back on Monday at 9, I put out the Journal of Environmental and Public Health comments on the SARS economic impact, and you can get an idea of that. But to Brett's point on that turnaround, back in 2003, the economic disruption ended rapidly once SARS was brought under control, and you saw a big bounce back in the economy, like Brett was saying. The growth rate returned to the pre-SARS rate 3 months after the outbreak's peak and then benefited from the release of pent-up demand after that. So that brought the total drag on growth for 2003 to 0.5% of GDP. Now, GDP was down 8% year over year, um, the during the period during the quarter when that was. So you can kind of see that bounce back and what Brett's getting to in terms of this being a little bit more of a weather type related event that's some sort of structural decline um, than some of the structural decline that we're looking at. So I think that's something to keep in mind. You certainly want to be cautious of it, but like I've been saying, you're kind of looking more at this as an opportunity to buy some pullbacks. I think people today are going to be a little bit too early on it. Brett, I don't know if you have any thoughts on this turnaround Tuesday at the moment, but I'm looking for a little bit more of a slowdown to take place, and we haven't really gotten the economic data to really get behind that global growth story, which was going to be such a dominant factor in why equities were getting bought up in late 2019. You know, the end of the trade war, global growth in 2020, here we come. And that's going to be brought into a little bit of question in the next couple of sessions. So that's kind of how I'm looking at that coronavirus. Is that pretty much in line with what you see, Brett?
Absolutely, 100%. We haven't gotten the justification, but we may still, and I really don't think that this is going to be a derailing idea. So, and we also have, I mean, as far as the very short term, I really don't like to trade actively during the period where we have a lot of the flashiest names come out with earnings. I like to wait until, after it. I want to see us get past a lot of these mega cap tech names. And I think Friday is going to be an interesting trading day. But yeah, I think that the tape right now is especially for something like equity index futures or ETFs. You're looking at something that is a collection of individual stocks right now, rather than a top-down market. And for the last week or so, it's been a top-down market. But now we're too close to some of these giant, super important individual names coming out with their report cards and their outlooks, that I think that things turn into really more an accumulation of individual names.
All right. We're running just about on an hour here. We try to keep this within an hour. So, two concepts left that I wanted to throw at you, Brett, and we'll discuss this. And then, we're always available to answer questions on feedback if anybody has them. But in the fund managers survey, we saw a new number one tail risk come to the forefront. It had obviously been dominated by trade war concerns, and I think the only time it took a break from that trade war concern was a China slowdown, which I guess you could equate to a trade war concern. Trade war is still running second, but the top one that came in at 29% of the respondents was the outcome of the 2020 U.S. presidential election. Now, with that, one of the things that I think that the market is discounting with all the coverage on the epidemic side of things is Bernie Sanders did pop to the lead in a lot of polls here. So, I mean, we're not a political show. We're not trying to predict how anyone's economic policies are going to come out, but there is certainly a sentiment in the data that would be concerned with some of Bernie Sanders' policies. So, how are you paying attention to this, Brett? And what kind of things are you looking for?
I think it's interesting to watch the narrative play out. I just, from a purely quantitative, data-driven standpoint, I think that you can go back a century and no incumbent has ever lost when you have a situation where you're not seeing a complete unraveling of the financial and economic environment. That means a two-term president, regardless of what you think about anything else involved. That's a difficult data point to overcome, no matter who the primary victor is. So, but obviously, if you're concerned with tail risks, you're concerned with how the narrative is going to evolve. I mean, there's no question that a far left progressive viewpoint is going to contain a lot of factors and elements that markets aren't currently positioned for. So the degree to which that becomes plausible and credible as an outcome, as a piece of the outcome distribution that you have to take into account with your positioning, then it's going to cause a lot of adjustments. And so it's natural for people to start thinking that that's a tail risk for sure.
Okay, and then the number 3 and 4 risks, they kind of play in together and lead us to our next point. Bond bubbles popping, that was 20%. And the number 4 was monetary impotence at 14%. Now, with that in mind, we've got the Fed tomorrow. Now, by most accounts, the Fed are looking to keep this out of the news, I would say for the most part. They are reviewing their inflation targeting strategy. I don't think they're going to be ready to provide a any sort of any sort of commentary on this, on the exactly which way they're going, until mid-June. This obviously goes lock and step with the ECB doing their strategy as well. But one of the concerns is that the Fed could potentially slip up and pull away that punch bowl that they've laid out. Brett did a good job at kind of explaining exactly what we're doing, and a lot of that's been in the line of talking about inflation and the ability for the Fed to have room to maneuver above that 2% target. So obviously we got Powell tomorrow. It is not an update in trajectory, so it's just going to be the statement and then Powell speaking. I think he's done a good job at learning the parlance of a Fed chair over the last couple of periods. Certainly had a difficult time at the end of 2018 there, but 2019 saw a nice recovery and a smoother transition for him. But is there anything you're going to be looking out in that Fed uh, either statement or Powell conference that would have you take note?
So I think that we're going to see a very predictable outcome here of a complete non-factor and a reaffirmation of the idea that the Fed is going to in no way do anything to endanger the curve that we're on right now, and probably reaffirming the idea that this is a new approach for the Fed. That is, we're not going to be looking at predicting inflation. We're going to be looking at when inflation is manifestly and immediately a giant boogeyman staring us in the face, teeth baring, eyes red, and we're going to react to that. And we're not going to do anything to try to predict it, because we've done that, and everybody around the world has done that several times over the last 10 years, and every time it's turned out to be something that just put us back into a deflationary scare without ever really courting any kind of inflationary problem. So we've been lulled into the idea of believing that inflation is a great thing, and that's going to probably, I think, continue to be the case until inflation is suddenly obviously a bad thing again. And we've created conditions for which it can be. What's that?
I said you talked 10 years. How about 30 years for Japan at this point now, you know?
Yeah, so exactly right. And so, yeah. So I think that there is an accepted worldview at this point that inflation is a wonderful thing if you can get it. And that will be the case until we get to the point where we're screaming in pain from inflation, whenever that is. Maybe that's 10 years from now, maybe it's 50 years from now, maybe it's 2 years from now. I have no idea. But that's going to be what it takes, I think, to change the new paradigm. And I think that the Fed has adopted that paradigm at this point, which means I think that we can assume that they're going to enable that paradigm. They're going to default in that direction around every corner. And I think that's one of the things that's driving this breakout. It's one of these contextual factors. So, I think that it sets the stage for monetary policy impotence to become the number one risk factor at some point in the future, if that paradigm is correct. Because the second that we get a downturn and the Fed, we're at zero or whatever, and people don't believe in QE anymore, and there we are. And that becomes, I think that it's natural for people to fear that, because that's so instantiated as the big scary boogeyman. And I think that we're going to hear the Fed continue to underscore the idea that no longer is it going to try to proactively get out in front of potential inflation by tightening policy at the first upward tick in a leading indicator. And I think that is really an enormous and important factor that is driving the market right now.
Right. So, and that's something that Brett and I will get into a lot more in detail next week, I think. Certainly we didn't get to cover nearly as much stuff as we would have liked to have today. So, it leaves us a lot on the table for next week. But I think that's kind of better anyway, because in the meantime, we're going to have the Fed to digest. We got a number of inflationary data points, including the PCE price numbers out on Friday, the employment cost index. So that's going to give us a lot to talk about. We'll also have at that point the PMIs and the ISM reports to get through. We didn't even get a chance to talk about the preliminary PMIs. So there's still a lot on the table that we'll be able to wrap up around it next week and get into a little bit more around the yield curves and the spreads between the 3 month and the 10 year and how that could be impacting markets and investment decisions. But Brett, you started off the piece by giving us a pretty good entry on the "You Are Here" recap in the last year of what we've been talking about. You want to do us a favor and recap the last 60 minutes here and tie it all up nicely for us?
Yeah, sure. I mean, so again, big picture for people who haven't listened to our analysis on this stuff or started to look at sentiment data, money flows data. You think of the world in terms of, well, there's fundamental analysis and there's technical analysis, and those are the two forms of analysis. And what we really try to do with this piece of our analysis is show that there's another axis that is independent from the other two, that is a completely separate data point that can inform things in a really powerful way. It led us to be able to see in September and October of last year that there was really only one way for the market to go, and that was a big rip to the upside, because people weren't positioned for that, and it was still set up completely. And it's because we saw those data points showing that people had over discounted the possibility of a big contraction that really fostered that possibility. People were already in the bunkers in a situation where there was still a lot of constructive possibilities in the outcome distribution. So it's a separate data point, and most importantly, it's something that a lot of people don't focus that much on, which, if you understand markets as complex systems, that's the most important thing that you can find. When you find data and analysis that's based on something that most other people aren't looking at, but it's intimately woven into the outcome distribution, that's the most important data, because it's not discounted in the way that people are making decisions, because they're not focused on it. So at this point, we're tracking the process of building towards some kind of exuberance here, and we've gotten there with a lot of options data points, but I think we need to move the target a bit, because we've moved to a different phase of this bull market, something that's sort of past the wall of worry. We're seeing more retail participation. We're seeing where we might get more of a multiple expansion. In part, it's because we've got the easy comps coming at us. In part, it's because the Fed has pledged to not tighten, even if it sees strong growth. And we're already at, low interest rates, and we're doing what's tantamount to QE. All that's already happening, and we're not going to take the punch bowl away even if we see strong growth. That's a pretty tough environment to not participate in, especially when you're coming out of a context late last year where a whole lot of people weren't participating in it. So we've got that kind of contextual, what I've called a contextual bullish storm, and we're a perfect storm. And we're seeing some exogenous catalysts enter the picture that really don't speak to the cyclical situation. Something like the Iran military conflict, something like the coronavirus, they really don't represent any read into the cycle, any read into the structural health of things. They just set back sentiment, they pull in risk, they bump up hedging, and they present the possibility for some very low probability big bad wolves. But they, as Gavin said a moment ago, and as I said previously, something like the coronavirus, it presents a situation where there's probably a lot of built up, pent up demand that's just being put off into the future. That's a future we're going to get to. So probably this is another buy the dip opportunity. I'd like to see a lower low. I'd like to see people get a little more hedged, a little more scared. Hopefully we'll get that opportunity, but probably this is not a cyclical turn. Gabby, there?
Yeah, there you have it. Sorry, I had myself on mute there. So yeah, anybody that might have missed this, we will be posting a replay on it shortly. So, you'll have time to go through and kind of digest some of the concepts that Brett and I are talking about, and hopefully we laid out a little bit of a teaser for what you can expect next week, and we'll probably be discussing some of the Fed issues tomorrow as well too. So, hey Brett, as per usual, thanks for joining us here. Another good conversation. Hopefully, it provided some value to the users out there. And like I said, any questions, feel free to write in.
Thanks, Gav.
All right, talk to you soon.